Hi there, welcome to this webinar on stress testing in Advisor Go. Today we've got a plan in here which you can put in via a guided case study, and if you see in your panel that pops up, you should see handouts. That's your guided case study to enter this plan, so feel free to use the handout, or if you can't get access to the handout, just let us know at support@planwithvoyant.com and we'll send you a copy. So in this 30-minute webinar, we'll be looking at how to stress test a cash flow plan, including how to model market crashes and using the insights area. We'll also cover growing assets by a portfolio rather than entered growth rate and what impact this has when running the insights. If this is your first webinar, welcome. See our previous webinars on the YouTube channel called Voyant Australia. This particular plan, like I say, we have a guided case study for, and see the handout section in your panel for that handout. When you enter investments or supers into the plan, there's a section called growth, and I'm going to start there with looking at, first of all, how some things in the plan are assumed to grow each year. So in dashboard, I'm going to start in the savings and investments section where I've already entered in all their savings and investments, and click on John's general investment account. In here, there's a growth section at the top left to say how this account is going to be grown each year. You have a choice in here of choosing enter growth rate or portfolio. Now, enter growth rate will just grow the account by this growth rate here, 5%, minus any fees. So if I go back to basic, it's 4.5% net, and I'll show you how to check that in a second. Now, note if you have any dividends or interest, these are in addition to that capital growth rate, so just keep that in mind when you're entering them in. Let's go check that then. So in year view, top right of the chart, or double clicking on a bar, you can go into the year for each year of the plan. I'm going to go to the investments. I'm going to find John's general investment account, and there's that 4.5% net growth. If I click on the account name, you can see the gross of the 5% minus the fees gives that 4.5. And if you did have any dividends or interest and so on, you'd see the net growth assumed total and the breakdown within here. Now, note when I scroll using the square, it stays at 4.5% through the whole of the plan. And it will do unless you've got a step in there to change it. The other way to grow an investment or super is by portfolio. And when speaking about portfolios, we first need to take ourselves to plan settings. So in dashboard, I'm going to go right down to the bottom to plan settings. The two areas we're going to look at are asset allocation and market assumptions. So asset allocation is the default portfolio asset allocation that is used when you choose to grow by portfolio. Now, you can change it on the individual item level, but this is the default one that will come up if you select portfolio in that drop down that we were just in. So let's enter some percentages into here. And there's another screen, let's put some 20 in property. So that's my default portfolio and the average expected return. To see the assumed growth rates behind each of these asset classes, go down to market assumptions. And in here, you can see the growth rates and standard deviations for each of the asset classes that I can select in asset allocation. So now I'm going to go click done. And what I'm going to do is go to John's Super and change the growth rate to using our portfolio as opposed to an entered growth rate. So go to pensions, find John's accumulation super, and in growth, top left, we're going to grow this account by portfolio holdings. Now, the best thing to do when you select that is then click on portfolio, and you can see the assumed portfolio asset allocation, which is the default one that I just set up in my plan settings. As I say, you can change that for the individual account. So it's 4.68. If I click done now, what this means is when I go to year view and have a look at the growth, it's 4.18. Why is that? Let's click on it. It's 4.68 minus the fees. Okay, so we've now set up our plan with at least one account using enter growth rate and one account, which is John's Super, growing by portfolio. What we're going to do now is create a what if scenario where we're going to do a market crash. There's actually two ways to do a market crash scenario in this system, and I'm going to show you the one using events so that you can see how to put multiple market crashes on the plan if you'd want to. So take yourself down to the plus button, go to event, and in special events, which actually do something in the plan, these ones at the top here are just place markers, but special events actually do something. We'll cover some of these other ones in a separate webinar. We're going to click on major loss. When shall we do it? Let's put it in for John's age 49 and then done. So what we're going to do now to see what exactly is happening, if I click on John's age 49, there you can see the major loss event. Let's go to year view and we can check the details. So what I'll do is I'll scroll along to the age 49 year and I'll go to the investments and you can see it's applying a minus 35% drop minus the fees. So it's a fixed drop on those accounts that are investment accounts growing by enter growth rate, and it's not affecting savings. However, if I go over to the pensions, you can see that John's Super is only dropped by minus 7.82. Now, this is because we were growing the Super by a portfolio, and for example, if I had a bit more equity holdings in that portfolio, then it would have had a higher crash than it does here. So once you start using portfolios, they do start getting a bit more nuanced in terms of how much the crash is in the plan. Okay, so what we're going to do now is go to the insight section. And like I say, you can create multiple events there if you want to. What we're going to do now is go over to the insight section and look at some of these insights. This is where a lot of the stress testing of the plan can be done, and it can start conversations around, what if, and will we be okay if? And these values aren't providing advice, but can show the plan's reliance on invested assets, give an indication of wiggle room in terms of growth rate and risk. And if you'd like, you can use it as a segue to explain what you're putting in place and why. So we're going to start with the performance insight, and that is here. So when I click on the performance insight, we can have a look to see, well, what if consistently throughout the plan, the returns are lower than expected or higher? So I'm going to slide the slider down by one notch and click Get Started. What the plan will show up the top here is that each of the investment accounts, again, savings haven't been affected, but each of the investment accounts have dropped. Now, if they're dropped by entered growth rate, they'll have dropped by 1% because it's one notch. But again, if it's using portfolio, then it won't have dropped by 1%, it'll moved more towards the downside. Then you can see, okay, what impact has this had on the chart, and toggle back, if you'd like, to the original plan and look at the assets for the insight versus the original. If you'd like to double check the details in any of the insights, you can go to year view and scroll along to see what's being assumed in the plan. The next thing we're going to look at in terms of insights is we're going to go right down to the bottom here and look at the Monte Carlo. At the moment, the plan is assuming the set fixed rate growth each year, and it's using historic and Monte Carlo that you can change that, so you can have a different growth rate for each year of the plan. So both the Monte Carlo and the historic must have at least one account growing by portfolio. That's the asset allocation that you set up, so that it knows that the standard deviation of these investments and the bounds of which to randomize the returns. In fact, these ones are probably best where many of the investments are set up using this approach. On accounts grown by portfolio, so let's click on Monte Carlo. This insight will randomize the returns for each year of the plan for each iteration. So here we've got 50 iterations, and I'll click Get Started there because it'll take a little while to run. It will give an overall probability of success for the plan. Now note, success is defined as an iteration that does not give rise to shortfall in any year of the plan. Now, we haven't actually talked through what's in this plan, but there's a big car purchase that they can't afford in their pre-retirement years. So if they have no chance of affording this, we'll see that come out in the Monte Carlo. In a minute, it will display the assets chart showing the range of possible asset values over time with the average as a dotted line. So as I say, the probability of success is 0 overall, which is expected as there is red for John's Porsche purchase. And if we go up the top right here to the yearly probability of success, that's the year that the car has been bought. In other words, it's very unlikely that they'll be able to afford that car given a randomization of returns for that super account. Now, if we go to the assets chart, you can see the range in values over time. And what it's doing is allowing the impact of randomizing the returns and volatility and what that means about achieving their goals in the plan. So here's their goals down here. Other goals are okay, but not John's Porsche. If I take John's Porsche out of this plan, for example, I think I tested that yesterday and the probability of success is around 90%. We have multiple guides on this Monte Carlo one, so if you look on our knowledge base at support.planwithvoyant.com and search Monte Carlo, then you can find many guides for further information. In Insights now, let's have a look at historic. Again, like I say, you do need to have at least one account growing by asset allocation before using Insight, as this is the account that it will be changing the returns for. In this insight, it maps historic returns onto the chart for the accounts that are growing by portfolio, and other accounts will remain at their entered growth rate. So you can select a period of time for the S&P 500 index at the moment, and it will overlay that onto the plan given the portfolio. What you can do then is again toggle between the original and the insight, and the nice thing about this is you can click on year view and see, so let's have a look at this John Super that is the one growing by portfolio, the change in returns each year of the plan. We've still got our market crash in there, but you can see that it's changing each year that we scroll through. Now, Julia's Super was grown by entered growth rate, and that is why it is staying at 5.5% and not changing. So if you want to look at stochastic modelling, basically historic and Monte Carlo down here as long as you're growing some of the things in the plan by asset allocation. If you don't have anything growing by asset allocation, it will prompt you to say, you need some things growing by this. Do you want to change them? Just note when you do change them in this screen, it changes them for your whole plan. So you may need to go change them back if you don't want them staying like that. The next one we're going to look at is the loss capacity insight. So how much could the plan lose at a given event and still be okay? So let's click on the loss capacity one. What you can do here is change the event that this happens at. So for example, we could say at retirement, what is the loss capacity? And actually at the moment, not very much. In different plans, you'll see obviously different amounts depending on the assets that are in the plan. And you can have a look, and that makes sense because there's not much left at the end of this plan in terms of liquid assets. So again, what you can do is go to year view, and you can see what assets are dropping by which percentage rate and the loss amount. So in other words, it'll apply this growth rate in that year to those investments. The final one I just want to mention before we go is in the insights, you've got investment returns. In the savings webinar that we did last time, we covered annual savings and lump sum savings. And in this one, we're going to do investment returns. So this will give you an indication of the required rate of return in order to run liquid assets to zero by the end of the plan. What you can do then is compare this to the growth rate that's being assumed, and you can show any wiggle room. What we're going to do here is I'm going to run it from after the Porsche, because it doesn't like when you've got red in a year that it's trying to solve it for, because it can't work it out. So make sure there's no red in this between the start and the end event. But we'll average it for the whole plan. And the required rate of return is assumed to be 4.96. So not much different from what we have in the plan. Some investments at the moment are growing by, so if I go to original, some investments are growing by 5.5, 4.5, and so on. What you can do as well, if you want to, is you could create a what if scenario and change the growth rates on the investments in the what if scenario, so you can compare plans that way, or do changes to the growth rates in a particular plan in a particular way manually in the what if. But the insights are a great place to do this really quickly without having to create a what if scenario. You can run the plan. The last thing we're going to do is go to Let's See, and we're going to compare plans chart view to see, okay, what difference has the market crash made on this plan compared to the base plan. Now the key chart here, if they've still got sufficient assets at the end of the plan, is to look at the assets chart. In the top chart, you can see there's a little dip here just when there's that major loss event. So there's that dip, and then at retirement, they have less in their supers because of that market crash. So what have we covered? Savings accounts aren't affected by any of these stress testing if it's in cash. Investments and supers are, you can choose whether to grow it by an entered growth rate or by asset allocation. And then when you use the market crash, anything entered by entered growth rate will drop by a fixed amount, and anything entered by portfolio will drop by a more nuanced amount depending on what that portfolio is made up of. You can then use some of the insights to stress test the plan once you've created it and have a look at them. You'll probably get the ones that you want to use each time, for example, and then if you want, you can do in reports, got some of these have a report option. You can, via a rebrand, so if I just go to plan settings, these market assumptions, any default portfolios you want to set up, the market crash percentage rate, things like that, you can alter in a rebrand. If you want more information of those, you go to the website, products, all products, and have a look at white labeling. All right, we have raced through that today. That's pretty much all I want to cover on the stress testing aspects.
Thanks for listening.